Have you ever wondered why some companies stay private for so long and then they become public, and why some companies become public earlier? That's exactly what we're going to cover in this video. If you're new to this channel, my name is Mariusz Konieczny. I run MicroCap Explosions, a website dedicated to microcap stocks which are ignored and underfollowed by the investment industry. I also wrote about 10 books on investing, one of which is available for a free download at microcapexplosions.com. I also created valueinvestinguniversity.com, which is a free resource to make you a more intelligent investor. The traditional path for most companies that end up trading on New York Stock Exchange or NASDAQ is the following. Somebody has an idea for a product or service. They develop the product. They either fund the development with their own money, with their friends' money, or maybe venture capital or angel investors can come in and help them finance this project. They will get sales, they will get growth, and then when they become big enough, either profitable enough, or maybe the forecasts become beautiful enough, then at some point they go public, and they immediately go public on New York Stock Exchange or NASDAQ. That's the traditional way to go IPO. An alternative way, some companies choose to go public earlier, and they can do that on secondary exchanges, such as over the market, OTC, over the counter, OTC, Toronto Stock Exchange Venture, CSC, Canadian Stock Exchange, AIM, and whatever other venture exchanges. They choose to go public earlier because they want to give their investors liquidity earlier. And you see, I am mostly involved in those companies that choose an alternative route. But I'm noticing and I'm realizing why some companies choose to stay private longer. And that's because public investors are absolutely crazy. They have no idea what it's like to own companies that are during the early stages of development. They are so scared. And you can see the examples of what is happening with the stock price of Voxter, for example, what is happening with the stock price of Secure. I mean, it is like an elevator up and down. Every little thing happens, people panic. It is absolutely crazy. You see, in the private hands, owners are more calm, reasonable, level-headed, because they don't have Mr. Market every day quoting them the price. So if a business in the private hands, with venture capital included, is going about its day, developing, getting clients, if let's say they are unprofitable or the revenues, don't grow as fast, their shortfall is simply covered with another capital raise. And another capital raise is priced at a level that the business is valued based on where the business is. So they value it based on fundamentals, not fear, not craziness. They value it like, okay, you're now valued at 100 million. We're going to raise $5 million. It will cost 5% dilution, right? And nobody panics. Nobody screams. Nobody is calling each other's names. Nobody says, I told you so, and all this. It's just part of business development. And you see, when those companies that really traditionally should be in the private hands are on the secondary exchange and are already public, they go through the same development, like a business development. They have to get clients, they have to grow, right? They have to spend money, and some quarters might be better, some quarters might be worse. But during the time that they are, think about this. Think about the difference. Think about the difference. You are a real estate developer, okay? You are building a house. Okay? And that's all you have. You are building a house, and that house is in the private hands. You put in the foundation, then they start, putting the structure of the building. They start doing the interior, windows, this and that. And while this is all happening, things around the world are happening. And so those things are outside of your control. You have certain issues that you deal with. Electrician doesn't show up because they have another job. Somebody gets sick and then they can't put the toilet in on Monday. Instead, they will put it on Monday 3 weeks later, right? These are the normal things you deal with, right? And you're like, well, that's part of the business because we have to finish the house. We have to go through all of this, put the landscaping in, put it on the market, hire a realtor, and when it's finished, we're gonna sell it, right? So you're not worried from day to day, right? Now picture this, the same building now, it's in the public hands. And every little thing happens in the world, that house could be, oh, it's 10% more or less, or 10% less, 20% more, 20% less. Some days the market is like, you know what, they're never going to finish this house because Putin is going to kill all the people in Ukraine. You know what, I don't think they're going to be able to install the windows because oil is too much and the supply chain disruptions are this and that, and interest rates are going up, so therefore nobody will be able to afford this house. And every day Mr. Market comes in and prices your house that is in the development minute to minute. Do you think that owner, the developer, would be as calm? No, he would be driven absolutely crazy by this craziness and constant activity. You know, electrician doesn't show up because he's sick or because he has other job. Now the market is starting to price in, maybe we will never get an electrician to come in. Maybe they will never be able to finish the house. You know what? The management is not executing because they told us that it was going to be done on Monday and it's not done on Monday. You see what I mean? That's the difference. So people that invest in small micro-cap public companies, they do so because they want that upside, right? They want that upside, they want that 10x, they want that 100x, they want that. But unfortunately, most people are just not cut out to be in that space because first of all, they don't understand how businesses operate. They don't take the time to do due diligence. They don't understand that small businesses are like 3-year-olds and they try to compare them to adults, okay? Adult, mature companies, that's how adult and mature companies do. They do investor relations like this, you know, they report quarters like this, they're stable. They try to compare 3-year-olds to adults. Well, that doesn't work because 3-year-olds understand things differently. 3-year-olds have different things in their mind. 3-year-olds grow at a different rate than adults do. Right? So it's a completely different skill set, completely different understanding. And unfortunately, most people should not invest in small or micro-cap stocks. They should not. They don't understand them. They don't want to learn about them. And then they are like hyperactive. Okay? And that's a recipe for disaster. When you invest in those small companies, you have to have nerves and stomach full of steel. You have to have so much understanding and conviction in these companies, in these businesses, or you will be shaken out. And sometimes the stock price absolutely makes no sense. It is completely disconnected from fundamentals. And if you let Mr. Market tell you, based on the stock price, how your business is performing, you are going to fail. So if you don't do your due diligence, if you don't have super high conviction in these ideas, and if you don't have stomach for volatility, you will get run over. So in such case, you are much better off investing your money in index funds and big cap stocks. You're not going to make as much money, but you're never going to lose as much money either. And you're never going to experience the crazy volatility that is associated with the small cap names, especially during the times of uncertainty like we are experiencing right now. So that's it for this video. I hope you enjoyed it. I hope you became a more educated investor. Take your time to subscribe to this channel, like this video, leave me a comment, and thank you for watching.